All right, we will go ahead and get started here with Unit 1 titled Essential Financial Questions. So, Unit 1 is composed from portions of chapters 1, 4, 7, and 8. Before we get into each section, I state what chapter the material comes from. I would highly recommend reading each of these chapters, particularly focusing on the areas that are covered within this unit course pack. So, hopefully, you've all printed this course pack out and are able to take notes as we work our way through. But let's go ahead and get started. So, what we're first going to do is set the foundation. So before we launch into our study of financial markets and institutions, we want to set this foundation, and we're going to do so by exploring 6 essential questions. Basically, our 6 essential questions are the 6 different sections of this first unit. So our roadmap, first section will be why finance? So why do we need finance in the first place? Second section, what are financial markets and institutions today? So we will define them, provide examples, and what their roles are within the financial system. We'll continue on and state and identify what is the Fed and what does the Fed do. How does the stock market work? How does a mortgage work? And then also some supplemental material. What is the student debt bubble? This is a topic that may be particularly interesting to many of you. But as you can see, next to each section, I have broken it down and identified which chapter this material comes from, so it would be wise to read those chapters in addition to watching this lecture. So our first section here in Unit 1, our first lecture topic is why finance. This comes from Chapter 1 and also some supplemental material. Our learning objectives for this first unit are to understand, first of all, what are the problems with direct lending. So we'll first identify what is direct lending or define what direct lending is, and then we'll identify what the problems are. Second learning objective is what are the benefits of financial intermediation between savers and borrowers. And then third is to learn some key definitions in finance. So big picture, why do we need finance in the first place? So the first thing that I want you to do is consider a world without banks. So you're working, there's no banks, and you actually have some savings. You have 2 choices to do with these savings. So without banks, no stock markets, no financial institutions, what can you do with that savings that you have accumulated? Well, one, you could hold the cash. So you could just sit on it, put it underneath your mattress, put it in your closet, put it in a safe in your home, but you could just hold the cash. Or 2, you could lend your money to someone with the promise that he or she will repay you. This is direct lending. So one of our learning objectives is what are the problems with direct lending? So most likely, if you're going to lend your money to someone with the promise that he or she is going to repay you, you're going to ask for some additional compensation, right? You don't just loan money and forego the use of your money without any additional compensation. So what are some problems with this direct lending? Well, first and foremost, the most obvious problem with direct lending would be that the person just takes your money and leaves. They just take your money, they up and leave, or you loan them $10,000 for some investment, and you see that they invest your money poorly. So, one of the biggest problems with this direct lending is the cost to monitor the borrower. So you need to monitor, are they going to repay you? What are they investing your funds in? So this cost is not just time, but also money. That could be a big problem when you consider this direct lending. Second problem is the length of time to pay you back. So how long is it going to take them to repay you that $10,000 that you lent them? Most startup businesses don't turn a profit until year 3. Are you willing to forego the use of your money for 3 years? Third problem with direct lending is the risk that you cannot sell your investment without a significant loss in value. This is what is called liquidity risk. You should know from previous courses, or at least Finance 3000 if you've taken Finance 3000, that liquidity is defined as the ease of conversion to cash without a loss in value. So consider the scenario where you lent that individual $10,000, but all of a sudden you have a family emergency and you need those funds back. They've already invested the funds and they are not able to pay you back that $10,000. So you may be required to take only a fraction of that money back in the event that you need the money immediately. So you have this liquidity issue. So enter finance. Okay, so due to those 3 problems previously listed, most people won't do this direct lending. But you don't really just want to sit there on your cash, you want to have it grow, right? So enter financial markets and institutions. So let's first define a financial institution. A financial institution is an institution that performs the essential function of channeling funds from those with surplus funds, which we call suppliers, to those with a shortage of funds, which we call the users. So some examples of financial institutions would be commercial and savings banks, credit unions, insurance companies, mutual funds, investment banks. These are all financial institutions. They help channel funds from those that want to invest it, those with surplus funds, to those that need the funds, those with shortages of funds. Enter financial markets. Financial markets are arenas through which these funds flow. So these are different characteristics, different types of financial markets. You have primary, secondary, you have the New York Stock Exchange as an example, you have money markets, capital markets. We'll go into a lot more detail on the different characteristics and types of financial markets here as we progress through this first unit. But the first thing about financial markets is that you'll see that financial markets are differentiated by the characteristics such as the maturity length of the different financial securities and instruments that are exchanged. So that's where we get into our money market, capital markets, less than 1 year for a money market, greater than 1 year for a capital market. Oftentimes your financial markets are differentiated by certain characteristics of the financial securities that are offered. Keep that in mind. Moving forward, why financial institutions and markets? So how do financial institutions and markets help answer or help solve those three problems that we listed previously with direct lending? So the monitoring cost, the length of time for repayment, and the liquidity risk. Well, one, financial institutions can monitor on the behalf of a group of lenders. So instead of you assuming the sole reliability of monitoring this borrower that you have loaned money to, now that responsibility falls on these financial institutions, and you have some protection. So, for example, you put your funds into a bank account, and the bank account then you loan some funds into a bank, and then the bank takes those funds and turns them into a loan for some other investor. The bank is the one that is monitoring that investor. So you have some protection, whether it be by the FDIC on your investment, up to $250,000, but they are now taking the cost of that monitoring. Okay. Secondly, with the financial institution, you can get your money out quickly. So if you invest in this commercial bank and you deposit in this bank and you want to get your money out quickly, you can just simply withdraw it when needed. And thirdly, deals with financial markets. Financial markets provide buyers and sellers, potentially allowing you to sell without a significant loss in values. So again, these financial markets bring the buyers and the sellers together so that you have another person on the other side of your transaction. So like if you owned Apple, you made an investment in Apple, it would be pretty easy to convert that ownership claim into a cash flow with these financial markets. Continuing on, so talking about the supply and the demand for funds. So these financial markets and these financial institutions and financial markets act as what is called an intermediary or a go-between between savers and borrowers. So savers supply the funds. They have excess funds. They can invest in something, whereas the borrowers demand the funds. They need these funds to invest in some type of capital budgeting or capital in some type of assets. What the financial system does is it allows you to transfer funds from the savers to the borrowers. So essentially you have these savers that are supplying the funds, and then you have your financial institutions and your financial markets that allow these savers to supply the funds to the borrowers. So let's take a look at this hypothetical yield curve. You have the savers, which are supplying the funds, and you have the borrowers, which are demanding the funds. And let's say that there is the intersection of these two lines, of these two curves, is what determines the interest rate on this potential loan. So for example, think of a small business loan. You have suppliers that are investing in this small business. You have the small business demanding these loans. Where this supply and demand curve interjects, that's the interest rate on that small business loan. So we'll talk a lot more about how government actions actually affect this interest rate. But what's key for this chart right here is to understand that savers supply the funds, borrowers need the funds, and you have these financial markets and institutions that act as intermediaries between these two to bring them together to help the flow of funds within this financial system. So, continuing on with the flow of funds. How are these funds transferred? So, once again, a financial system is what transfers funds from savers to borrowers. Okay, so within this financial system, you have what is called financial intermediaries. Financial intermediaries that act as go-betweens. The definition of a financial intermediary is an institution or an individual that acts as the middleman between two parties. So basically, they're more like a broker, okay? They don't actually own the assets. So you've got banks, mutual funds. These are the financial intermediaries that act as go-betweens between the savers and the borrowers. Now, sometimes you'll have financial institutions, like we just discussed previously, your commercial banks, credit unions, investment banks. They also act as this financial intermediary between savers and borrowers. Then you also have these financial markets that issue claims on the borrowers. Claims in the form of equity, so ownership claims, or in the form of debt, which would be interest payments. So what you have is over here on the left-hand side, you have households, firms, and governments investing funds into financial markets, either in debt or equity claims, or into financial intermediaries, which could be investment banks or other financial institutions. And these funds then are transferred over to the borrowers, those that need the funds. They invest these funds, they start earning profits, or they're making their interest payments, and the returns on these are then sent back to the savers. This area right here is the financial system. Okay, the financial system is composed of financial intermediaries, which includes financial institutions oftentimes, and also financial markets. So what are the benefits of having this financial system? Well, one, financial institutions can be a delegated monitor that collect information on borrowers for the benefit of savers. So we talked about one of the problems with direct lending being the cost of monitoring. Financial institutions can be this delegated monitor. We do actually have a definition of what this is on the next slide, so I'll leave that there. But they can collect information on their borrowers at a cheaper price or at a cheaper cost than if you were to have to do it on your own. Secondly, savers can be more diversified by investing in banks or mutual funds. So instead of direct lending where you're investing in just a single individual, you can also be more diversified now by investing in these banks that have multiple companies and multiple individuals depositing within that particular bank or having their funds within that particular mutual fund. Savers then are able to convert their investments more easily into cash, so you have greater liquidity. The benefit of the financial system being that now you are able to eliminate some of that liquidity risk. And then lastly, financial institutions have lower transaction costs because of economies of scale. So once again, similar to what I mentioned on the first one with the financial institution being a delegated monitor and collecting information at a lower price, with these financial institutions monitoring multiple clients and multiple investors, the cost of their loans and their savings accounts actually goes down. So they can actually experience what is called an economy of scale. And again, I have that definition here on the next slide. This also applies to collecting information, not just transaction costs, but also collecting information on these different borrowers. So let's look at the definitions I kind of said we just have that we went through a little bit here on this previous slide. First one being a delegated monitor. A delegated monitor is an economic agent appointed to act on behalf of smaller investors in collecting information and or investing funds on their behalf. This is essentially banks. That's an example. A bank could be a delegated monitor where they are acting on the behalf of all these individual investors, investing funds on their behalf. Then you have what is called asset transformers. So asset transformers, the definition is financial claims issued by a financial institution that are more attractive to investors than are the claims directly issued by corporations. Pretty difficult definition there. Think about a bank taking a liability, so that would be a deposit that someone made or an individual or company. They take this liability, which was a deposit, and they transform it into an asset. Or, for example, a loan that another individual or entity could take out. That is what asset transformers are. They take a liability and convert it into an asset. Next definition is the definition of diversify. This is the ability of an economic agent to reduce risk by holding a number of different securities in a portfolio. So you're decreasing the risk of the entire portfolio by investing in multiple different types of securities. You're eliminating the unsystematic risk of your portfolio. And then you also have economies of scale. Economies of scale is the cost per unit or customer falls as the number of units increases. So think about being an individual investor and paying $100 for a broker's report on a $10,000 investment, or being a financial institution that's looking at a $10 billion investment, and you have they're able to have the cost per unit be substantially lower due to this economy of scale. So, changing directions a little bit, why do you need finance individually? So without finance, where would you be right now? Well, let's say you want to go to college, but you don't have the funds to go to college. Looking at the price of attending Ohio University, so this is from July 13th, 2018. The cost of going to Ohio University 1 year is about $14,500 a year. So, over the course of 4 years, you are spending roughly $58,000 to come to Ohio University. So you made a financial decision to come to school over going straight to work right after graduating high school. So let's consider, how long would it take a high school graduate? How long would they have to work in order to save that approximately $58,000? Well, if we take a look at this chart, this is from 2018, so it's from 2015, a little bit dated. But if you look at the median usual weekly earnings of a high school diploma, it's $678 of weekly income. Even if you were to assume 2% inflation over 4 years, that would be approximately $733 of weekly income with a high school diploma. I'm going to use the $678 in my analysis. But let's do some quick math. Let's say you make $678 a week for 52 weeks. That's about $35,000 a year. After you pay taxes and your other expenses, insurance, rent, whatever they may be, let's say you have $10,000 left a year. After 5 to 6 years, so you've saved $10,000 a year, you needed $58,000, and at about 6 years, you've saved enough to come to OU. Now, after 4 years, with a bachelor's degree, if I go back to that previous slide, the median value on a bachelor's degree is $1,137. Multiply that by 52. Your average salary per year is approximately $59,124 a year. So that's a 68% increase per year from what you would have made just coming straight out of high school. Finance is what enabled you to invest in yourself. I know some of you maybe were able to receive funds from your parents for college, but some of us also had to take out loans. It was this loan where we were the borrower, we needed capital, that allowed us to be sitting in this classroom right now. So finance has enabled us to invest in ourselves, our human capital, so that our future can be more promising. Okay, so now that we have discussed why we need finance individually and kind of how it's played an important role to where we are thus far, let's turn our attention back to the financial system, so financial markets and financial institutions. This is all extra material, but what I would like to do is kind of just go through this relatively quickly and kind of build as to showcase where our current financial system actually came from. So in ancient times, you had merchants and you had farmers. These merchants and farmers, they both needed funds to do business. So this is when simple borrowing and lending developed. So farmers would take out loans. They'd pay off their loans with their crops. The merchants would take out loans to buy inventory. They would pay off their loans with the revenue from selling this inventory. This was the first time that you had your simple borrowing and lending being developed. Moving forward, we move forward to the Roman Empire. With the Roman Empire, this was the first time that you had mortgages. So Julius Caesar, the Roman emperor, he declared a law that banks can actually seize land if the mortgage was not paid. So this was the first use of collateral where you had this asset backing your bond or backing your loan. Then after the Roman Empire fell, banks remained but they were in a very limited role. Why? Because they said that during this medieval time, charging interest was considered immoral. So banks had a very limited role up until even in this medieval time. Then moving forward to Venice, in the 1100s, the city of Venice actually issued bonds to fund their wars. So these were the first bonds. So they had to fund their wars because Venice was a major trade center. They had to fight wars to eliminate pirates. But this was the first time that bonds were issued to help fund the war at that time. Moving forward into the 1300s, these Venetians could actually purchase and trade these securities. So you had a bond market. So you had the buying and selling of these debt securities. This was an early financial market being born. So this was all the way in the 1100s to the 1300s. Moving forward into Holland, you had successful bond and stock markets. So the Bank of Amsterdam was actually set up to receive deposits. They actually sold perpetual annuities, so essentially bonds with a fixed rate of interest. And then in 1613, the Amsterdam Stock Exchange developed trading in annuities and stock in overseas trading companies. This is where we finally had worldwide trade. So this was in 1613 when the Amsterdam Stock Exchange was developed. Moving forward, you had in the UK in the late 1600s to the 1700s, you had joint stock companies. So joint stock companies were where investors could buy shares that would pay dividends. So they would pay dividends from proceeds of all voyages to the Far East. And this is when the Bank of England founded and sold English consols, which are bonds. Okay, so you have these joint stock companies where you can receive dividends for equity shares, and you could also have these consols being sold. And then last up, 1792, that's where we had the creation of the New York Stock Exchange. Okay, so now let's turn our discussion to our American markets. This is kind of just showcasing where this New York Stock Exchange was developed, but let's move into a discussion on American markets. So as I mentioned, 1792 was when American markets were actually developed. The first stock exchange was actually in 1531, but in 1792, that's when we had the New York Stock Exchange. This is not this was not obviously the first stock exchange. I mentioned that there was the first stock exchange was in 1531 in Antwerp, but there was also the London Stock Exchange, which was created in 1773. So less than 20 years later is when the New York Stock Exchange was created, and it actually had fewer restrictions than the London Stock Exchange. As a result, it attracted more companies to actually list on the New York Stock Exchange than on the London Stock Exchange. So what type of impact did that have on the American economy? Well, even though we have booms and we have busts, you can see that there has been a dramatic increase in GDP per capita over time, showcasing, well, GDP is a measure of your standard of living, but you can see that the standard of living per capita has increased over time since this introduction of the New York Stock Exchange, and since the introduction of this American market. With this introduction of the American market, it showcases that there are more funds available for businesses through these exchanges, which helps promote economic growth. So what are the keys to a successful financial system? Why did the New York Stock Exchange actually, why has it been so successful? One is having freedom with boundaries. So one reason why the New York Stock Exchange was more successful than the London Stock Exchange is because it had fewer restrictions. So there were fewer restrictions on those companies listed on the exchange, and so by establishing this financial market to do business, it did actually benefit world trade additionally. And the second part with this freedom is that you also need to have boundaries. Okay, so regulation is what helps keep things in check. You need to have necessary restrictions on manipulative trading. There's been people that have created fake companies and then went bankrupt. You have traders that have manipulated market. You need to have some type of boundaries, otherwise no one's going to lend new money, right? So you have to have some freedom, so fewer restrictions, but you also have to have some boundaries in order to have the confidence and the faith of investors to invest in these companies. A second key to a successful financial system is correct incentives and standards. So if your upfront incentives and standards are correct, you will have better outcomes. So there's a lot of research that shows that corruption actually stunts economic growth. Basically, if you have correct incentives, if you make a bad investment or a bad decision because you're negligent, you should lose your job. If you're diligent and you make smart decisions, you should be financially successful. If you're honest, you should get more clients. If you're shady, you should get fined. So you should have correct incentives, correct standards to enforce better outcomes. lastly, what is finance? So Dr. Kelly Bergsma Lovelace, a professor here in the finance department, was asked to create one picture that defined what finance was, and I thought this was a great picture, and I'm going to showcase, and I'm going to kind of go through her picture of what finance actually is. So there are two perspectives in finance. The first perspective are firms. The second perspective are investors. Firms need capital, so what they do is they issue debt, so they borrow, or they issue equity shares where they issue ownership in their particular firm. Then investors that have surplus funds will either buy bonds, these debt securities, or they will buy equity securities in these particular firms. Now, for these investors to loan their funds to these companies by either purchasing the bonds or purchasing the stocks, they're going to require some return on their investment. So they're going to require return to provide their funds in the form of a bond, or they're going to require a return to invest equity ownership in a company. This return is just what is called a required return. A required return for an investor is a cost to that particular company, to that particular firm or that particular entity. So this is finance as a whole. You have firms, firms can be, in this scenario, firms you would think of as a company, but this can also be government entities issuing debt. But firms issue debt or equity when they want to raise funds. Investors purchase these debt issues or purchase these shares of equity in companies, and they require a return. That required return then is a cost of capital to the actual company. So if you think to our three tracks for finance, if you are a finance major at Ohio University, you either choose the corporate track, or you choose investments, or you choose financial planning. The corporate side of finance deals more so with this firm side of this diagram. The investments and financial planning side deals more with the investor side of this diagram. So that is section 1 of this first unit here. What I would like for you to do is review these concepts. Make sure that you can answer these 3 questions. Why do we need finance? What are the problems with direct lending? What are the benefits of a financial system? If you have any questions on any of these, please don't hesitate to reach out. I can help try to clear anything up. And keep in mind that there is a wrap-up or a check-in question on McGraw-Hill Connect to check your understanding or check your participation in viewing this lecture. So I will see you, or I will talk to you during our next lecture, which discusses what are the financial markets and institutions of today. Stay safe, everyone.